In this presentation I want to go through the introductory aspects of property investment finance, and to do that I'm going to be working through the introductory PowerPoint presentation that you will find in Module 1. The first question that some students have is, what exactly is property investment and how do you do it? Well, property investment has to do with owning property for the purpose of making money. And once you look at property like that, you're looking at it the same way that you would look at perhaps buying shares, fine wine, maybe putting money in a fixed deposit, depending on how adventurous you are. Perhaps even betting money on the TAB as a form of investment. And certainly we find that that kind of investment language is being used by the TAB more and more. So let's look at the property investment question. I want to work through just how complicated it is and hopefully convince you that property investment is easy and approachable, although it has some unexpected advantages and disadvantages. Certainly by number of investments, more Australians choose to invest in property one way or another than in any other form of investment, except for perhaps superannuation, which after all is compulsory. The advantage of property investment is that most people have tremendous confidence in where the property market is going. There's the old truism that property only goes up in the long term. And so that means that people are willing to take a bet on a property investment, whereas perhaps they may not be quite as optimistic about the share market or some other form of investment. The other advantage of property investment is that you can borrow money against property very easily. As we go through the course, we're going to look at exactly why this is and what it does to property investment, but for now we'll just simply see it as a very approachable aspect of property investment. You can't borrow money to maybe put it into a fixed deposit, and if you borrow money to invest in the share market, you'll find that you'll end up in a very risky situation at all. But most people are of the opinion that borrowing money to buy your own house is very sound and solid, and so if you're in the position to be able to do it, borrowing money for an investment property can't be too far off a good thing either. So let's look at what we do. The first thing is that if you go along to your local real estate agent and get an idea of affordable properties in your area, and here on the slide that we're showing you a couple of them, it's fairly easy to get an idea of the price of houses or home units or apartments or any other form of real estate that you like. I'm going to be using residential property investment as an example, partly because numerically it's a very common form of investment, also partly because I expect that you'll be more familiar with this part of the property market. However, what you'll find is that investing in other sectors of property pretty much follows the same rules. And so if you want to invest in industrial property or offices or retail, very much the same rules. The only difference perhaps is that if you want to buy yourself an office tower, you'll need to be looking at being able to marshal a lot more money. So we'll simply start on residential as an example. The example also is going to be single tenanted, and this is simply to make it easy to consider the issues. Multi-tenanted buildings, say an entire block of home units, is not fundamentally different to a single tenanted block. It's simply a bit more fussy because you're going to have more leases and more rent to collect and perhaps a large number of costs to consider. However, once we get our head around a single tenanted simple property, then we can apply what we know to all sorts of other properties. Okay, we go along to the local real estate agent and we find that in our areas, say for example, we're looking at an average property in the vicinity in this particular locality. It's a suburban capital city area. We're looking at property being available for about $600,000. We'll say $580 for this particular example. We also look in the window and we'll see that there will be other properties available not for sale but for rent, and usually there'll be a whole swag of these. and fairly quickly you'll get an idea of the kind of range that you're looking at for rent in a particular neighbourhood, and so you'll be able to get an idea of what the property you're thinking of would be able to rent. And certainly if you go to look at properties with a real estate agent, they will be able to give you a very good idea, although perhaps a little bit optimistic, of what your proposed property is likely to obtain in rent. One way or another, as long as you get those two numbers, the price to buy and the rental value, perhaps with a grain of salt, a little bit of reality pushed in to take out the risks, you have the basic foundations of the data that you need for property investment. So you find your property then, find its rental value. You then have to estimate the other costs. Now, to own a piece of real estate is a little bit more complicated than owning a share in BHP or something, because you are the owner of a physical asset, which means that you have to maintain it, and there are a number of costs that go along with that. There is a cost associated with collecting the rent, because usually you'll get a real estate agent to do that for you. It might be in the vicinity of, say, 5, 6, 7% of the rental income. There'll also be insurance, local government rates, there will probably be maintenance, and we can distinguish maintenance between the maintenance that the tenant would be expected to pay for, which relates to things that the tenant may cause, by comparison with general normal wear and tear on the property which the owner has responsibility for. Say if the roof starts to leak or something, obviously that's not going to be something that is the result of the way that the tenant has abused the property, but simply something that happens from time to time and is a normal part of owning a property. So you have to estimate the costs. When it comes to property, you don't have to use debt finance. However, it's so common that it's normally considered to be the norm for property investment. And so you have to decide on a finance strategy. Finance strategy is a fancy way of saying you have to work out a strategy, or your chosen strategy, for how much money you're going to borrow and where you're going to borrow it from. The simplest approach is to borrow from the bank using a normal property mortgage. However, there are other and more complicated approaches that we'll be reading about later. After you've collected all of your data, which is the 4 items above, it's a matter of evaluating the performance of your property. And then after that, we just move in, buy the property, find a tenant, and away we go. While you own the property, it's necessary to manage the property, and this is as simple as giving the property to a real estate agent to find a tenant for and collect the rent for you, but you also have ultimate responsibility for things like the maintenance and those expenses we're talking about earlier. At the end of the period of your property's investment period, at the end of the time when you get sick of owning it, you're going to be looking at selling the property. Generally, we assume that property will eventually sell for more than we paid for it, because this is pretty much the experience that we've had ever since white men set foot in Australia. And so we anticipate that selling it is going to be a vital part of the overall investment performance, because we're looking for a capital growth. Now, in some parts of Australia, and perhaps at some points in the future, the confidence of obtaining a capital growth on the sale of investment property is not nearly as strong as it once was. There are many parts of regional Australia, for instance, especially in smaller towns, and again, especially if the local industry is going poorly, say the rural industry, agriculture, is maybe not going so well, or maybe everyone's moving out into the larger towns nearby. And so in a lot of smaller towns, property values are actually have been going down for some time. And so I just put it to you that you need to be a little bit careful when you make estimates or forecasts about where property growth is going. By contrast, if there's a mine opening up, or perhaps a military base is going to be established nearby, or some other major change, perhaps a shopping centre is going to come to town, all of these things a property investor should have their eye out for, because these will likely cause property growth to blossom into the future. Okay, so you manage and sell the property eventually. It's important to be aware of the risks involved. The fundamental risk in property investment is vacancy. That is the unfortunate possibility that you may not be able to find somebody who wants to rent it from you. By and large, residential leases are written over periods of about a year as the norm, sometimes 6 months, seldom more than 5 years. What that means is that every 12 months you're either renewing your tenant's lease or you're looking for a new one, and depending on the market and the location and so on, you can need to allocate perhaps a week or two of vacancy from one tenant moving out to another tenant moving in. And if we're looking at an area which is overall not doing so well, say a small regional town, you may find vacancies that run a lot longer. So vacancy is a risk that property investors are very, very conscious of. The second risk is the ultimate property growth rate. That's important when it comes to selling, but also in terms of being able to forecast where your rental income is going to go. If you intend holding the property for, let's say, 10 years, the rent in 10 years' time is going to be perhaps a lot higher than it is today. And so market movement is very, very important in evaluating the performance of the property. The last risk is operating costs. We've mentioned maintenance, for instance. You might look at a property and think that it's all very sound, but in 5 years' time you might discover that the foundations are failing, or perhaps there's termites, or perhaps the paint hasn't performed nearly as well as you had hoped it to, or maybe the galvanised roofing has also failed, and you need a lot more expenses than you expected. So they largely are the risks involved. While we're talking about risk, I'll just briefly mention that market risks can, on occasions, be considerably greater than expected. And we are probably aware of the property cycle or the business cycle. We tend to assume that about once every 8 or 10 years, property and the economy in general tends to have a bit of a slump. And if you find yourself wanting to sell in that slump period, then your overall investment performance won't look very, very fine. If you're able to hold on to your property through a property slump, even though you might be a bit pessimistic and maybe you have a bit of vacancy, there's every chance that holding on to the property despite the pain during the property downturn might be well and truly worthwhile. Let's do some initial analysis on this property investment. Let's assume that we buy the property for about $580,000 and we do get the $450 per week. What we can then do is look at how the property is going to perform. If we make some general estimates about management, maintenance and other expenses, we find this particular property has a gross yield, in other words the ratio of the rent divided by the value of the property, of about 4%, about 4.05%. By the time we look at a net yield is the yield after the costs have been taken out, we find that comes down to a tad under 3%. At this point we can look at the property investment and say, is that really worthwhile? If we're considering competitive forms of investment, we might be inclined to say, well, maybe it is, maybe it isn't. If government bond rates were 4% and my net yield from my property is only 2.92, certainly I'd probably be less likely to look at property, especially as property one way or another is certainly going to be a bit more risky than government bonds, even though we think in terms of property investment as being safe as houses. However, if on the other hand we're able to be confident that property growth was going to be 4 or 5%, let's say 5% to be a little bit bullish, we find that the net yield of 2.92% actually comes up to being something a bit more attractive. because you're really earning the 2.9%, the 3% roughly, per year from your operations. You're earning your rent. As well as that, you're earning perhaps another 5% in terms of capital growth. So your rent is going to be increasing year by year, and by the time you get to sell it, you're going to be selling the property for a lot more than you bought it for. And so in that case, we roughly add those two factors. Let's say property growth of 5% plus a net yield of about 3%, so we're looking at about a 7% return. Now we're starting to look like something that's fairly attractive. And so if we're looking at government bonds as, let's say, 3 or 4%, property as earning 6, 7, 8%, obviously we're in front by going for the property. And perhaps at that point we might say, well, the risks involved in property, okay, we've got a vacancy risk perhaps, but if we're cautious with our numbers, maybe that is not so great. Really makes the property investment begin to look attractive. We can then move to help our property performance by looking at what other factors we can do to make the property perform. We've already seen that by simply considering the reality of property growth, we've lifted our performance from 3% to about 7 or 8%. Let's assume that we've got 5% property growth. We say, okay, then we need 7%, but even that is really a bit tame. I'd like to have something a bit more interesting than a 7% return. I can then look at the effects of borrowing money, borrowing to finance my investment. If I'm able to get interest or a loan at, let's say, 6%, and let's say I'm able to borrow, say, 95% of the value of my property, which is the kind of leverage which is not uncommon in the property industry. All of a sudden I find that my leverage return has come up to about 11.3, 11.4%. That's becoming very interesting. The last sweetener in property investment is the whole question of the way it affects my taxation position. In this particular case, if I have a tax rate, an income tax rate of, let's say, 30% of my income per annum, the fact that I'm investing in this property over the period that I'm looking at actually lifts my overall tax return from about 11.3, 11.4% up to around 11.7%. And so it's a rare case where my tax obligations actually cause my overall investment performance to improve. It's one of the little magical things about property. It's called negative geared investments. While it's very attractive, we're going to be saying some more about the negative gearing strategy or the negative leverage strategy as we go through in the course, because it has got its pitfalls as well as its obvious advantages. So we can see that property is fairly approachable as an investment. I can simply go down to the local real estate agent, look in the window, go down to the bank, talk to the bank manager, maybe do a few estimates on costs, and bingo, I'm able to own an investment of a few $100,000, perhaps even $1 million, depending on my overall income situation and how much money I'm able to turn to the investment project. And that's one of the reasons why a lot of people find themselves as property investors, even though they may not have hundreds of thousands of dollars to speculate on the stock exchange. Let's look now at the question of how real estate works as an investment vehicle. Why is it that property is thought of so attractively? The first thing to keep in mind is that in our culture, in the West, property is purely an investment. Now you might say, well, I want to buy my house, and I'm not going to be investing in my house, I'm going to live in it. Whereas in fact, we tend to still think of even our houses, even the properties that we use ourselves, as a form of investment. Very few people have very much to do with property without thinking in terms of what the resale value is going to be. and someone might come knocking on your door offering to rebuild your kitchen, and one of their sales pitches will be in terms of think of what it will do for your resale value. And so even owner-occupation of humble houses is really part in investment. By contrast, indigenous people and people in ancient times thought of property as something else, something that was more a part of them or a part of their history, attachments to the family. Maybe, you know, your pet dog has been buried in the backyard and you don't want to part with that property. There are lots of ways in which property becomes a part of us, socially or personally. I know of lots of families where the children have grown up in a particular location, and so for the parents to part company with the family home would be something that would be quite upsetting for the younger people in the family that may have only known that location. And say in other parts of the world especially, this kind of identification with the locality is very, very strong. And you don't need to go into indigenous communities to find that. You'll find it in many parts of Europe where people have lived, or their family and their ancestors have lived in the same place for perhaps thousands of years. However, our way of looking at property is purely as investment. Ultimately, we're thinking in terms of the cost. If we buy it for ourselves, we're going to be buying it to avoid paying rent. And so it tends to be denominated in terms of dollars. The problem that we're eventually going to have to grapple with is how we actually get the number of dollars that we spend on our property. This is the major question behind valuation. I don't want to go too far into that at this moment, but I just want to introduce the idea and get us to think about the way that valuing land in terms of its investment value isn't as easy as it looks. It certainly is a lot more complicated than simply waving our arms vaguely in the direction of supply and demand and then walking off as though you're some kind of a guru. Supply and demand may explain some of the psychological factors of the market, but they certainly don't give you any hard reference point for working out the investment value. That hard investment value, or the real value of property, is something that people have been thinking about for some time. One of the first people to think about that was a chap by the name of William Petty, who was an Englishman some centuries ago. And he was trying to work out what land was worth, and the best he could come up with is to say, well, if I'm able to earn a certain amount of rent from land, that's a bit like being able to earn a certain amount of interest from money in the bank. And what Petty said was, if I can earn, let's say 5% on my money deposited in the bank, then I should be able to earn 5% on my land. And so if I'm able to get a rent of, so much, £10,000 or something, in Petty's world, well, that means that the value of the property must be 20 times that, so that would be £20,000 in order for the return on my land to be comparable to the return on money, 5% in both cases. We've already seen this in a previous slide when we were looking at the psychology of investors when they consider whether or not to put their money in fixed deposits or put it in property. When we're thinking about this question of real land value, we have to keep in mind the fact that value is different to price. The fact that I might consider, say in Petty's example, of a property being worth, let's say in Merry England, £20,000 worth of property, that may not necessarily be its price. Its financial value might be £20,000. However, the market might be very aggressive and they might be charging or wanting to charge you £22,000, £25,000 for that same block of property. Doesn't mean you can't buy it for that. It simply means that when you do, because rents won't change, you'll be earning less than the 5% that you would have in the bank. Alternatively, the market might be very slow and you might be able to buy that property for, let's say, £10,000 or £15,000, in which case your return is more like 6, 8, 10%. And so the price of a property is not necessarily its value. It's one of the unfortunate things of the terminology in Australia. We tend to think of property value all over the place, whereas in fact we should be thinking of property price. In the United States, we don't or they don't talk about property valuation so much, they talk about property appraisal, because they recognise that an appraiser is really estimating future price. The value of property, if it's looked at as an investment, and again thinking about what Petty was doing, of a property from a financial point of view, the value is the present value of the future returns. Now, some of you will remember that that definition is something that you found in general finance. That's the financial value of anything. A share in BHP, a bottle of wine if you're keeping it for investment, a piece of real estate, whatever it is, a taxi license. All of those things, their financial value is the present value of the future returns. And that means the relative value, the relative contribution of the rents earned plus the capital gain on sale. Another question of terminology that we need to get our head around fairly early in the piece is to recognise that, strictly speaking, land is not capital. For that matter, money is not capital either, although these days we commonly bunch them all together, and we even add other things like people and perhaps puppy dogs as capital. Anything that we own is capital. Strictly speaking, capital is an asset which is used for the earning of an income that is a human product. Land is not a human product, neither are people and puppy dogs for that matter. Land is considered capital merely because it performs like capital. And so we talk about land being capital because in our culture we think of property only as an investment. Again, this is in distinction to other people such as indigenous people and so on. To make land capital, to make it perform as capital, we value it using, those amongst you who are valuers will be aware of this, we use what's called the capitalisation technique, which is where we divide the rent by the yield which we're expecting. In the example from Petty, we were talking about 5%. So we divide by 5% or multiply by 20. Achieves the same thing. Capitalisation turns land or real estate into capital in the same way that when we put that suffix "-ize" onto anything, it means that we're making it into that thing. We turn land into capital by capitalising it. We can summarise the ideas that we've gone over in this presentation and also introduce a number of important terms which are used in the property investment world. First of all, we've seen that rents accrue to the property and flow to the owner, and that provides the basic reason for property investment. The relationship between, or the ratio between rents and the property value gives us our basic yield or our gross yield. Next, we have to consider the costs of managing the property, of owning it. These are referred to as outgoings in property circles. There are two types of outgoings. One are recoverable outgoings, those costs that the owner may have to pay for but is able to pass on to the tenant. These are referred to as the recoverable outgoings. The non-recoverable outgoings are the costs that the owner pays in order to maintain the property or keep the investment chugging along, and they then come off the gross yield to produce the net revenue, and the ratio between the net revenue from the property and the property value gives us the net yield, and that's really the more meaningful income stream. The relationship between recoverable and non-recoverable outgoings is very much a matter of the way that the lease is written. Often the basic costs of actually occupying the property going to the tenant, whereas maintenance costs and so on are held by the owner. However, that can change depending on the situation, and in some commercial leases more and more of the outgoings, the costs, are passed on to the tenant. The most complete of those is what's called a triple net lease, where virtually all costs involved in owning the property are passed on to the tenant. We don't have to worry about that too much now, but you might come across the expression triple net lease. And what that means is that there's virtually no non-recoverable outgoings. The net income to the owner divided by the value of the property gives you the net yield. And we use net yields most of the time when we're talking about the income performance or the investment performance of a property investment. It's important to understand that the rent which is actually being charged may not necessarily be the general market rent. When we talk about what the value, the rental value of a property is, that doesn't necessarily come to us through a particular lease. We have the actual rents that are charged within the lease. It's referred to as the passing rent. It's the rent actually specified in the lease and actually received. The market rent is what the rent should be, and this means that market rent might be either above or below the passing rent. If the tenant is paying a lower passing rent than would be appropriate if they went out and paid market rent for the property, we refer to them as them enjoying what's called a profit rent. Likewise, if they're paying more as a result of the terms of the lease than the property is really worth in rental terms, that's a loss rent. In some cases, for long leases, the value of the profit rent can be quite considerable. As the property market generally goes up and down depending on the property cycle, on occasions the rents which have been traditionally expected or maybe expected over the previous year or two may no longer be achievable because all of a sudden you're in a slump in the property market and perhaps an economic downturn for businesses generally, and businesses and tenants can't afford to pay the kind of rents that they were able to in more optimistic times. In those situations, you're either going to end up with a high vacancy level, or one way or another you have to cut your effective rent. Effective rent is the actual overall rental revenue that you're earning. Rather than charge a lower lease rent, a passing rent, often there are things in the industry referred to as lease incentives awarded to the tenant in order to basically entice them into the property. The two common ones are rent-free periods at the beginning of the lease, not uncommon in very poor times for perhaps a 3-year lease or a 5-year lease to have a rent-free period of a number of months, perhaps 6 months or even a year out of a 5-year lease. That really means that the rents have fallen by about 20%. However, the passing rent remains unchanged, and so it's good for saving face to a certain extent, keeping the appearance of the rents being high, even though they've fallen considerably. The other form of lease incentive, which is very common in the commercial sector, are fit-outs. When a tenant moves into a property, often they will have to fit it out, pay for renovations and changes to suit their particular business needs. And often the owner will pay these costs rather than charge or let the tenant pay for them. And of course these can be quite considerable, and so they're also an incentive to get a prospective tenant to sign up with a lease, even though the passing rent might otherwise be a bit high compared to the current market. With all of these ideas in mind, this should give you a general idea of what's involved in property investment, and also introduce you to the terminology and also some of the issues, some of the potential benefits, and especially some of the risks involved in property investment. In the next module we're going to be looking at how to do the analysis, how to get that calculation of the 11 point whatever percent that the property is actually performing with. And this is where we're going to be looking very closely at the whole process of discounted cash flow.